Hey, Chris.
Hey Don, how's it going? Good, good. It's been a while.
Yeah, a little bit, but we're back.
So,
You
so
guys are, you guys are booming over there. Great to
yeah,
see.
yeah.
I
No,
see
we
the
definitely.
deals you guys are doing. I was like, wow,
Well,
wasn't
no, and
ready
I'm
for that.
excited for today because this is going to be the first time to give you kind of some background. When we launched the Avondale deal, which is the one that
Yeah.
you're coming into,
Yes.
I was so excited about that deal, and it was one of the newest deals we've ever done. We're buying it directly from the developer, and we launched it, and within about 3 weeks, we had raised almost $14 million. It
That's
was the
incredible.
single easiest raise that, and then
Incredible.
we had like a really nice institutional partner that was going to bring a $14 million check to take
That's
down the
huge.
$60 million project. And
That's
everything just
huge.
seemed to go so smoothly. And that was 5 months ago. And here we are on the
It's too good
property.
to be true.
So many things have happened between, when we got that deal under contract all the way till today. And you saw the 10-year treasury go from like 5.6 when we open up the pro forma here, I'll go ahead
Yeah.
and jump into that one.
Yeah.
Um,
I'd love to see
but
it.
like
Yeah, I can't believe it's been going up so much.
to show you where we were when we underwrote this deal versus and all the things pretty much changed for the better. They've been like kind of like, hills and valleys as things usually go. So things that haven't changed are the purchase price. Purchase price is the same. What has changed is where we were looking at interest rates. We were looking at getting a 5.9% interest rate, 4 or 5 months ago. I think the
Yep.
10-year was like 5.5. In between now and then, we saw it dip all the way down to 3.44 was like the low on the treasury.
Hmm.
And then today, I think it's at like 4.3 and change. So if
Yeah.
we were to close on this property today, the interest rate would be like 5.4. So the
Yep.
model has basically 50 basis points of expansion on the interest rate.
So what were you able to lock it in at?
We haven't locked yet.
Oh,
So
you're not locked.
yeah,
Okay.
that was one of the challenges for this deal is the reason we didn't close 3 months ago was because we got close to the closing table and the pref group that we had been working with, we had a term
Hmm.
sheet signed, we had everything ready to go. We got 3 days before close, and the fund that was going to fund the pref said that they weren't going to be able to perform. And, we flew out to meet with the seller because there was no broker. So we sat down with the seller, we explained to him what was going on. And the pref group said, we have fund one and we have fund two. And fund two is interested in it. They're based in Atlanta. They're really excited about it. So we allowed them to continue evaluating. The seller was gracious enough to say, we really like you guys. We believe you can perform. We see that you've already raised your equity. We'd like to give you an additional runway. And they gave us all the way until December 12th, which that was, gracious of them.
Yeah, no doubt. Well, you guys did fly out there, so
Yeah, and they did
that's a
say,
smart thing to do.
yeah, they
Plus, they're
did,
in Atlanta with you guys have a stronghold, right?
they did say the seller's actually Chicago based. That was one of the things we
Okay.
really liked about the deal was the developer still owns it. Like they went to build this
Oh,
thing in the end of 2021, 2022, and planned on selling this at like a much higher price, almost $20,000 more than we're buying it for. But in 2022, that was when you saw all of the rates kind of expand, cap rates also expanded, and there just wasn't a market there. So these
yeah.
guys that are developers in Chicago own
Ah,
this one property in Atlanta. All their other properties are closer to home that they can manage. And they've been managing it just because they didn't want to sell it at the bottom of the market. And when we got into 2024 and they started to see rates coming down a little bit, the path was in the future, that was when they partnered with the group CSL that we partnered with and
mhm.
ultimately went under contract. And then when we came in with the equity, they were really excited to get this deal done because they're still on a variable rate loan that's in special servicing. So they were like, look, like we want to close with you, but we also have to answer to the bank that's being, generous with us based of our track record. So I sat down with him and I said, just like I told you,
Mhm.
we raised so much capital so quickly. I was like, I wouldn't be able to replace a $14 million pref check though with, a week's notice.
Yeah, sure.
They were resoundingly, when they looked at everything we'd put together, they appreciated that we'd flown out. They gave us the time. And very quickly, like I made calls to a lot of the larger folks that invest with us, and a lot of them committed larger amounts of capital. And we opened up the wait list because we had a pretty significant wait list. And then we brought on another pref equity group. And that was where, they're the people that we closed with for villas in New
Okay,
Braunfels and the ones that we closed with for Dawson Forest in Dawsonville, Georgia. So now we're working with someone that they're our contact that we've closed with twice before. We feel a lot more comfortable. Now the
sure.
size of the preferred equity went down. So where the group that we had never worked with was offering us 14 million, this group was only offering us 9.5 million.
So that's why you had to make the difference. Okay.
That's why we have to make up the difference. So what's been really challenging is, we've already successfully launched this deal.
Mhm.
And now we've launched another deal and we've raised all the money for that deal. Now we're trying to figure out, like, how do we go back to all of these people that don't remember Avondale and are really upset that they didn't get into Bluebonnet. And
That's it.
you were one of those folks who were like,
Yeah.
you saw the build to rent, you saw Bluebonnet, you saw that it was a really great deal, and it was. But what we're trying to do is help people understand that in many cases, Avondale was the superior deal, and the
Yeah.
same reaction was the one we got when we started a wait list. We had almost $1 million just sitting there where we couldn't accept.
Wow.
A lot of those people went into Bluebonnet. So now
Yeah.
going and being like, hey, Avondale's open again. Why do you move back into this one? They're like,
Yeah.
no, I kind of like the one, it was, good
How,
timing for me. So
how long is the hold on Bluebonnet?
see, and that's the thing. And I think that's the thing that people, forget. So like if you look at Avondale,
This is
Avondale
3 year, right?
is
For
a
this one?
3-year hold.
That's what I
So
liked about it.
and that is the selling point, right?
Yeah, big time.
We put 5-year debt on it, so we have flexibility. We could hold it for
Yeah.
5 years if we want. The reason Avondale was so attractive and why you're getting such great IRR is I think, you're looking at 21% IRR, 22% for Class C,
Yeah.
and pretty strong equity multiple even in 3 years instead of 5.
Yeah.
The reason for that is because it's a newer property and it still has a really rich tax abatement.
Yeah. Oh, okay.
The reason we know that we want to sell in year 3 is there's significant burn off to that tax abatement in year 4. So we could hold it past year 4, but we're going to start having cash flow affected. So in my opinion, this is going to be one of those deals where we get to the middle of year 2, we're probably going to be looking at putting it on the market and
Oh,
prep.
great.
And it's all going to be dependent on what the Fed does and what happens
Yes.
now that we now know who is in the administration.
Yeah,
What,
that's a big wild card for you guys too.
right. And the last time we saw this administration was in 2016, which led to the 2017 tax cuts, which is
Mhm.
what started the multifamily boom because people were really excited about bonus depreciation. People were really worried about inflation from things like tariffs or things like, lower interest rates, and multifamily tends to be a really good hedge against inflation. So it's usually what we are hoping happens, and I think we're probably going to see a lot of this, is you're going to see a lot of the big institutions putting money into multifamily to kind of prepare for the uncertainty of, well, the certainty of what we think Trump's going to do, plus the
Yes.
uncertainty of, is it going to affect the economy with inflation in a really poor way? And if you combine
Right.
the two things, multifamily is, I think, in everybody's target.
Yeah.
Um,
Yeah, for sure.
so what I like, just like you mentioned, you have a 3-year hold and you're getting to redeploy capital in 3 years into another deal.
Yeah, that's what I loved about it.
And then the things that we know about the deal have gotten slightly better. So we have less pref equity. So that causes us to bring on a little additional equity, which could affect the returns, in a negative way, transparently.
Yeah, sure.
But you're getting less risk because
Yes.
the group that's in second position behind the loan is a lower number. The other piece that I think has changed is less proceeds. So right now the loan is looking at about 34.5 million based off of the new treasury and a lower rate. So
Mhm.
debt service coverage ratio, in the 1.6 to 1.8 in year
Yeah, that's
1.
great.
Whereas when we originally underwrote this deal, it was, I think in year 1, it was 1.53 in year 1, 1.74 in year 2, and 1.5 in year 3. Now it's above 1.6 in all 3 years. You can kind of see the real estate taxes, how the real estate abatement after year 3 starts to become more significant.
Oh, yeah.
$110,000 in increases. When you look at Bluebonnet's a solid deal, but you're accomplishing near the same thing. You're looking at a 13% IRR, which tells a story, right?
Mhm.
getting a 1.8x return in 5 years,
Yeah.
which seems like a better return than like a 1.6 to a 1.7x in 3 years. But the IRR tells the story on this one because the time value of money shows that the extra 2 years of hold time is causing your IRR to go from low 20s to low teens.
Yeah. And I like to look at AAR too, because this is 15.7 and the other one's in the 20s, for people moving their money that just want to compare it to their money in CDs or anything lower. It's very easy comparison to make, right? You get an average annualized return of this, or I could keep my money here. But yeah, so that's significantly higher on Avondale as well.
And that was like the big thing that I've been trying to help people understand because I don't want to see like a big influx of people in Bluebonnet shifting their money to Avondale, but I do want people to understand that if you look at the numbers, Avondale is a screaming good deal.
Yeah.
You know?
Like you said, especially when you can redeploy and you look at the next 2 years, and if you factor in the 5 years of money versus, this 5 years of money, like you said, they're both solid either way. But
Right. No, I mean to get like most people in this market to get, a mid-teens IRR and a 5.5, 5.6% average cash on cash, like
yeah,
that's pretty much our buy box.
yeah.
And that's what we look to do. This one's nice. What I did like about this one is when you go into the annual cash flow tab, even
Mhm.
without a redistribution of pref or smaller proceeds, really strong DSCR. So
Yeah.
that's
Wow. Yeah,
kind
really
of
high.
that's really where Vikings tried to be over the last, couple of years is how can we take measured risk, bring on deals that have really strong DSCR with fixed rate debt and create, really strong returns.
Yeah.
Um,
What a great model.
but, that's going back to Avondale.
So will you be updating the projection numbers so we can see what those look like as well?
Yeah, usually we don't. Usually we lock them
Oh,
up
okay.
and we keep it the same. But I think, given that we've had such significant changes, we might do that here. They're
Hmm.
for the better. But what we tend to do is we tend to take the better as maybe this, maybe it won't. We'll keep the conservative model with the worst numbers.
Yeah, that makes sense.
Especially since we don't exactly know where we're going to rate lock. I've been looking at the treasury like every hour.
So yeah, so you guys have basically just been watching. So if you have a dip day, then you guys are gonna lock. Is that the plan?
Yeah, today it's dipped, 3 basis points, but it's been kind of fluctuating. The thing is that when the president elect the election happened,
Yeah.
created this huge, robust amount of excitement.
Hmm.
And, the stock market, everything just started
Shut
roaring.
up.
I think there's going to be kind of a pullback, hopefully, and that'll be helpful for us. Yeah, the IRRs are here. You're getting slightly less than equity multiple, but in such a shorter amount of time. I know you just kind of went through this thought process of comparing Bluebonnet to Avondale. What were you thinking? Like, what do you think is helpful? Are there any other questions that you might have on this to kind of help, make you feel like you made the right decision, or that might
No,
help?
I would have gotten both, but I think Bluebonnet was just closed at the time, or was closing, and I just seen it at the last second. So I like both deals, to be honest, because they both looked really solid, great returns. And this Avondale really wasn't an afterthought for me. I was going to get invested in both if I could, but I did really like the 3 year on this just because you can turn the money quicker. I like that it was in Atlanta, that you have a bit large portfolio there. I always like that when people have multiple the economies of scale in a market, just because again everything's risk based, and not that you guys aren't super risky anyway, especially going at 1.6 DCR. Most people don't go in with that, and so that's already being conservative, which I already love. And so, but yeah, so those were the main. I was concerned a little bit because I know you guys talk about the portfolio and selling it as a portfolio, which I talked to Amir about.
Mhm.
And when you're selling the portfolio, yeah, if you're selling in a group, I wonder if you're, getting some sort of discount. Some of the other investments I had in the past, they discount them obviously because they're buying huge volume of units. But Amir handled that really well as far as looking at that and so forth. So wasn't
Yeah,
a big
I
deal.
think it's something we always want to entertain because
Yeah.
sometimes it could help both parties because the buyer is buying usually a lot of the discount that they get is that they're paying the transaction costs of one transaction as opposed to three. So if
Yeah.
you're selling it to a big kind of institutional group, they might
Yeah.
even be willing to pay a lower cap rate
Yeah.
because they're going to save several $1 million by not having three times the.
Oh yeah, I didn't look at it that way. Yeah.
But it has to make sense for everyone
Sure.
involved. So I think, with what is nice though is the Avondale deal being a shorter hold will kind of dovetail a little bit nicer with some of the deals that we're trying to exit in Atlanta.
Yeah.
So you may actually have an opportunity to sell a couple of these at the same time. What would be really nice is to package a really strong new core plus deal like Avondale with a couple of the value add deals that were bought in 2021 and 22.
Yeah.
Because if we can get a big institution interested in a trifecta of deals and give us, an even better price on those, that would really help out some
Hmm.
core investors that have been across multiple spectrums. But yeah, okay, great. Well, I really wanted to go through that process with you. I wanted you to,
No, thank you. I definitely learned more than, you gave me some other nuggets that I wasn't really aware of, or just the fact that from I haven't dealt a lot on the institutional side or in that major property realm. It's all, most of the people I'm with, especially with my clients, the sweet spot's 50 to 150 units, right? 50 to 100. So it's, there's all in these different niches. And it's great to hear. I'm glad I reconnected with you too, just to kind of see what your model is from the last time we spoke. In a year, so much has changed.
yeah,
We're taking on new people, development rope. But what I always loved is you guys really know how to build a team of experts and leverage off that, because things run really smoothly. You guys are on top of things. You have great response time, even this time with the Mayor and Amber, and you don't get that with a lot of syndicators out there.
yeah. Well, I love that that's your experience. That's
Yeah,
music to my ears. I've tried to build kind of a mentorship structure where Amir's now managing Hayden and Amber and kind of reporting up to me, which has given me the time to fly out and meet with investors and really
yeah, leverage your time.
help Judah. So
Yeah, well, you made the right choice, because that's the key, really. I mean, because you want people to just keep coming back, and everyone's so busy. I know I am. So the quicker and easier you can get things done, it is so much more helpful than not, or just getting the information and the transparency. People are afraid to be transparent, I find. And even with my clients, I always suggest, you have to be transparent, be upfront, tell what's going on. People, they're investors. They can make a decision, but having all the information, they see that you want to give all the information. It's a big deal because, again, you separate yourself from everybody else.
yeah, and in times of adversity, I feel, and this is what I train Amir and Hayden. I was like, look, if you ever feel like if you're not being transparent, that it's not going to help you, get an investor to come in with us, then
Hmm.
you still do the right thing. You're transparent, and they'll come back at a later date.
Yeah,
We
it's a
can't
long-term
control
play.
what other sponsors are doing, but we can control what we're doing, and
Hmm.
people will tend to gravitate to the people that are being honest.
Yeah, no, there's no doubt about that, because it's not always sunshine and rainbows. It's
No, and we
mitigated. We
definitely
mitigate
know
our
that.
risk.
The
Yeah, we
last few
mitigate
years
our
have
risk.
been.
Things happen. Like even what you said, like this one. You told me everything that happened. The story makes sense, and that doesn't mean it's a bad deal when someone backs out or can't perform or whatever. Sometimes things just happen, and you understand. But now it's even, like you said, could be a better opportunity the way it's going to be structured moving forward. But yeah,
Yeah.
anytime you guys get 3-year holds, I love those.
Yeah. Well, and it's nice to know when we're dealing with some of those institutional partners that maybe one doesn't perform, but then another group comes in very quickly and is interested and
Yeah,
underwrites and sees the value in the deal. So, we have always liked having those big institutional partners that are, almost checking our work and going over our underwriting and validating a lot of the things that we feel because a lot of those people have 10, 15, 20, 30 years experience.
one more thing I wanted to say about this
Yeah.
is this one is that with a 3-year hold, typically you're dealing with repositionings, bridge loans, right? That's another thing I liked about this one is that, you're getting conventional financing right out of the gate,
Right.
and it's not a turnaround property, but it's still a 3-year hold, right? Because obviously anytime you turn something around or the higher vacancy, there's more risk.
When we launched this deal, we were just structuring the development deal. And I
Yeah.
remember going to Ed, our asset manager, and Vic and Ravi, and I go, I know that I can raise the money for Avondale very easily because basically what we're offering people is a construction deal with
Yeah.
construction upside and 6% cash flow during the entire hold period.
Yeah.
I was like, my problem's going to be raising money for the construction deal that gets the exact same returns in the same 3 years, but offers zero cash flow the entire time.
Yeah. Yeah, it's true. That's what's hot about going having multiple at the time. I've seen it with Dave Lindahl in the past. He's the gentleman that I coach for, and
Uh-huh.
I seen that, and he had let two deals out at once. And what the problem was is everyone wanted to get in this one, not that one. They're both great deals, but because of some of the nuances. One question I do have about this: how are you going to navigate the abatement? Because obviously that's going to drop your NOI a decent amount.
Yeah.
on that. Did you say that was happening year 3 or year 4?
Year 3. So, I mean, the burn off has already begun, but the significant burn off happens going from year 3 to year 4.
Uh-huh.
So ideally, you always have the ability to hold a property longer, but there's this equilibrium point where
Yeah,
you're not going to grow NOI quickly enough to offset
the
the
number of
loss of
years.
value from the abatement. And
Sure.
that's where we've kind of identified it. In the event that cap rates compress quicker than we're anticipating, we'd
Hmm.
love to get out of this in the middle of year 2, going into
Yeah,
year.
sure.
But we made sure to use a 5-year loan, and we paid extra to have less years in yield maintenance and defeasance, so we
Yeah.
don't hit with a huge prepayment penalty. And that
Oh,
had a
that's
little
awesome.
cost on the front end, but it gives us the flexibility to where if we get to year 3 and say NOI has been growing and inflation is there, cap rates haven't come down enough, and there isn't enough interest, we have that possible other exit where we can say, we're going to hold this for another 6 months and try to identify the best time to exit.
Yeah, I like
It's not
that.
going to
I
be
like
a
that a lot.
situation where we have to think about a refinance.
Yeah.
So
It's always great to have options. I love having multiple ways because I mean, you can have all the insight you want about the future, but no one has the crystal ball. So the
right.
more you can maneuver, it just gives you so many more options. Like you said, yeah, it's a little more cost up front for the safety net, but it could
Yeah.
turn into a much bigger return at the end, or
Yep.
you know,
It was just like these guys. These guys built the property, and didn't anticipate the Fed raising interest rates 550
sure,
basis points in 6 months. When it was ready to be sold, it was the absolute worst time to sell the property, and they had to pivot. So
yeah,
it happens, and we try to make sure that we protect against that downside risk. But usually, if you're in this real estate sphere,
yeah.
you buy yourself time, you can heal a lot of wounds.
Yeah, no, that makes a lot of sense. How long do you take for a new development, like say 150, 200 unit property?
Yeah, so the
To,
one we're doing in Arizona, we
yeah,
have to where within 16 months it should be built.
wow, that's fast.
And the first 12 months you'll have this one in Peoria, it has kind of like townhomes around garden style. The
Yeah.
townhomes will be built in 12 to 14 months. And then those will actually start lease up, and then they finish the garden style in the beginning.
Oh, so the phases, so it's like done in
Bridges
phases.
bridges some of so you actually start getting cash flow a little bit
Yeah,
earlier.
increase the burn rate. Yeah. All right, that's cool. That's awesome. Good. Yeah,
So
that's all I have a question. I didn't have a ton on this one. Like I said, it may have helped a lot with just getting some of my initial concerns. That and also I haven't dealt a lot in the Class A area, and with the Class A's, people a lot more times are moving into homes, but in a situation we're at right now with how the rents are becoming so much lower than that, then it's not as big of an issue, even if, rates go down some, because that was a little bit my concern too. Hey, what if the rates have a big drop and then all these people want to,
purchase homes.
move into houses?
Yeah. Well, and what I noticed here was the tenant base was a lot of young professionals. Like it's in Decatur,
Mm,
so it's slightly outside of downtown Atlanta.
yeah.
But it's right next to a MARTA stop in
Oh yeah,
another.
that's what Amir was saying. Yeah.
Whereas, like when I found out it was next to a MARTA stop, I was like, is that good? Like,
Yeah.
I
Yeah.
grew
You're kind of
up in
weighing it out,
LA.
right?
Like if you were next to a train stop, like that didn't mean you were in a safe area. When I got there and I toured the property, I was like, wow, this is a beautiful property. It's like virtually brand new, really nice new finishes. It's surrounded by a neighborhood. So you have like actual single family homes that are selling for
Oh
$500,000-600,000
wow.
each, all surrounding the property. And then when you look, you can't even really tell there's a train station across the way. It's like a big like hill that goes up. And like if you walk around, there's steps that go up to a train station, but it's like not like you walk out your front door and there's like a
Trains
train.
across the street.
You would never even know if somebody didn't tell you.
Well, that must help with noise too, because that would have been one of my concerns of how
Mhm.
noisy it was. But in
And when
that,
I talked to the tenants were like, no, we love it because, we don't have to pay for parking in Atlanta. So we can
oh,
actually
that's
go
great
out
too.
there and
Yeah.
jump on a MARTA and within 15 minutes be in downtown Tampa. And a lot of those people work hybrid roles where they're like, I only have to go in 2 days a week. So
Yeah.
no, I was impressed. I
Yeah,
think
that's great. Awesome.
great.
Thank
Well,
you. Thanks for all the information. Great information. Thanks for sharing. I was glad to catch up with you as well.
likewise. Well, don't be a stranger, and we'll
Okay.
have to plan that trip to Houston soon.
All right. That sounds good. I'm so happy for you and all the success you're having. You guys are killing it.
I appreciate that.
Yep.
Have a good one.
All right. Take care.
Bye.
See ya. Bye.